Eric Ervin, everybody is looking for high dividend yield in this current low rate environment, but you say look for future dividend growth as opposed to a high current dividend yield. Why is that?
There's a thing we like to say is that boring is beautiful, and right now high yield is sexy, and usually those don't end well. In 2014, utilities were the best performing sector, and then they turned out to be the worst performing sector the next year. Right now what we've seen is all of these dollars chasing yield, and they're ending up with these kind of melting ice cubes, right? A business that can grow its dividends in the future is a business you want to own. A business that can't grow its dividends in the future is usually a business that might be on some shaky ground.
What have you seen in terms of dividend growth so far in second quarter earnings?
So if you look at dividends and earnings over time, they generally tend to track one another. As the earnings go, so goes the dividend. But the earnings are a lot more volatile. So we've seen negative earnings growth in the S&P 500 over the past couple of years here, and yet dividends have continued to grow consistently. The dividends of the S&P 500 right now are up around 2.5% for the first 6 months of the year, and that would put them up around 5.5% year over year. So we're still seeing the growth out of the dividend, but it's not quite as robust as it once was. Of course, we had the energy cuts, a few cuts from energy names in the early part of the year.
And utilities have really led the way up in the first half of 2016. So what should people do with their utility stocks, those high yielders right now?
Profits. You got to take profits. You absolutely need to be lightening up on these things. And we're not saying step on the brakes, but definitely take your foot off the gas and just elevate the quality of your portfolio. Usually quality overperforms the junk in a market. This year, it's been the opposite. Junk has rallied, quality's stayed relatively stable. Just take your foot off the gas. Take all those profits out and upgrade the portfolio.
And what about financials? Recently, the big banks, for example, Citigroup, they were allowed to raise their dividends. Some of the restrictions were taken off by the government. So is this a good place to jump in now to get some dividend yield?
Yes, in fact, so we watch this market very closely, and the stress test that the CCAR that was released, in fact, 18 of the 20 or so, 24 banks were all allowed to increase their dividends. In fact, 24 banks increased their dividends after that, but 18 of them increased far more than what the market expected. That alone was about a 100 basis point increase in the dividend growth of the S&P 500. So what you're looking for is, you're not going to get a massive yield out of these stories, but you're going to get earnings growth and you're going to get dividend growth out of that.
And you like dividends when it comes to information technology, right?
Yeah, and it's been the fastest growing dividend sector in the entire market. And really, if you think about, there's been some articles that say, is the golden era of dividend growth gone? Not even close. It's been 50 years of dividend growth with 3 down years, so 5 decades doesn't exactly make a fad, right? The infotech, though, has become the new real leader in this area. So much cash on the balance sheets. These companies are more mature now, so they're not having to reinvest it all back into the business, and you're seeing a significant amount of dividend growth there.
And then finally, you can track dividend growth through your ETF. This is the DIVY, and it's up around 3% so far this year. So tell me a little bit about the DIVY.
Yeah, well, so if you take it from, say, a financial advisor's perspective or a retired client's perspective, what they're really looking for is they're looking for stocks in order to improve their returns and bonds to reduce the risk in their portfolio, typically. What DIVY is really an alternative to that bond portfolio, that risk reducer. It captures the growth rate of the dividend without having to invest in the market. So if you can get, on average, the dividend growth in the market has been about 6.5%. If you can achieve something close to 6.5% with far less risk than having to invest in the market, you get a much better alternative to that bond portfolio. And so far year to date, it's doing just that. It's up around 3%, and we would expect, some continuation of that as dividends continue to rise in the S&P.
All right, well, thanks a lot, Eric.
Thank you.
And thank you for watching The Street.